Are you or your clients looking for a regular income solution with compelling returns to diversify your portfolio? If so, Neighborhood Holdings may be a great option for you. Listeners of this podcast will appreciate that public markets can be turbulent and finding a good private credit fund can be tough. But Neighborhood's track record, transparency, and investor alignment sets it apart from the pack. With nearly 10 years of consistent performance and a target net yield of 8 to 10%, Neighborhood has a track record of providing monthly income to investors without the volatility of public markets. How do they do this? Where banks invest in mortgages up to 95% loan to value, they also make borrowers jump through a lot of hoops. Many borrowers in transition aren't able to meet those hoops. Neighborhood has partnered with banks and brokers to provide quality borrowers with temporary financing secured by first mortgages at an average loan to value of less than 60%. Where other mortgage funds might take more risk by lending against construction, bare land, or jumbo loans, Neighborhood is focused on your average residential borrower who owns the average house in the neighborhood. Plus, their variable rate with a floor mortgage pricing benefits investors when interest rates go up and mitigates downside risk. Check out the link in the description or visit neighborhoodholdings.com to view the offering memorandum or speak to your financial advisor for more information. That's neighborhoodholdings.com/Loonie Hour. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back or have the shortest memories when it comes to investment. We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 169. As always, joined by the three amigos, Boomer, Keith Dicker, IceCap Asset Management, Rich Diaz, over in Portugal. What's going on?
Happy New Year, everyone. Loonie Hour. Yeah, we survived to another year. Did you do any resolutions? That's what they call it, right? New Year's resolutions? You promise something you can never keep, and then you pigeonhole it for later? No?
I have one. I'm going to read 12 books this year. Last year I did 8.
It's pretty good. I used to read a lot, and I just, life,
me too.
Business, it's been tough.
I just doom scroll on Twitter all night.
I don't know about you. I have all these little I subscribe to all these newsletters now, and that takes up my book reading.
Yeah. I read a lot, just not novels. But I think you have to, or not books in general. But I'm going to redouble my effort this year. I'm going to try to read 12 books, any kind of book, business books, novels. Any suggestions are welcome in the comments, by the way, people. Nothing boring and nothing too fun.
One of my favorites is Barnyard Dance. That's a good one.
Yeah. Hey, funny story.
Is that a real book?
Keith bought that book for my daughter, and that's one of her favorites.
I almost Googled that.
Yeah, it is a good one. Well, real quick, right? Because it was New Year's, and you guys won't know this because you weren't around then. But I think it was 1979, New Year's Eve, the Soviet Red Army hockey team played against the Montreal Canadiens at the Forum. Do you guys know? Maybe you read a book about it, maybe, or something.
Of course, I'm aware of this. I'm a Habs fan.
Yeah, and back then, you really had a big sporting event on New Year's Eve or Christmas Day. It wasn't a thing back then, but this was a big deal. And I don't know who won the game. I just know that, the Soviets had this guy, Vladislav Tretiak. I think that's how you pronounce his name.
That's the goalie, wasn't it?
He stood on his head. The Canadians at the time were rolling everyone. I think they lost 8 games that year or 6.
What year was this? 70?
I think it was 79. And
81 was it 81 or 82? It was the U.S. Olympics. Miracle on Ice.
That was in 80. Yeah. And but anyway, it was a real cool New Year's Eve story. So people who are older that are listening and watching, you're going to go, yeah, I remember that night. And it was so it became folklore. This guy did, Tretiak. I think it was 10, 20 years later, the Canadians, they actually drafted him in the last round just to make it a symbolic gesture.
48 years old.
Yeah, he was an old dude then, hey, but they drafted him, hey, because they always had that connection to him. But anyway, that's the banter. I know a lot of people love the banter in the beginning, and It's like two guys that don't like the banter, but you
Yeah,
better like that one.
somebody always timestamps when the
Always. Someone always
podcast actually
It
starts.
starts at 5:30.
I think we should keep the banter
One
going.
one week was it starts at 48 minutes, and it was over at 52.
I mean,
Make
that's
'em
funny. I
wait.
like that. That's a good joke, though.
That was a good one. What do you have, Steve? Like your
Well, actually, I was gonna
yeah.
I was gonna share my um, newsletter recommendations that I am subscribed to personally. In case anyone is curious, they might not care. So, but I'm going to share them anyways. Rich, you got your buddy Doomberg. I'm subscribed to
Yeah.
that one. It's one of my favorite
Love
energy
him.
newsletters. Doomberg, Keith, your buddy Luke Groman, Forest from the Trees. Jared Dillian, who's been on the podcast
It's
before.
good. It's good to know what's not going to happen in the world by reading that one.
Yeah, well, anyways,
Shots fired.
I enjoy it personally. It's a good read, but Keith maybe not so
Wait,
much.
Fiction
Jared
is
Dillian,
big.
I'm writing this
People love
down.
fiction as well, so that's cool.
Jared Dillion's podcast. He's been on the show.
Friend of the show. Friend of the show.
Yeah, friend of the show. Friend of the show, Bob Sakamoto, Ben Rabideau's Edge Analytics, which you have to be in the real estate industry to subscribe to, and Mortgage Logic by Rob McClister, who's writes a good mortgage piece on Canada's sort of mortgage market, and is frequently he gets like I don't know how he gets this. Maybe the Loonie Hour needs to get this, but he gets some sort of pass where he's able to jump on all the questions Q&A periods for Tiff Macklem.
Well, I've actually had a friend of mine. You two know him. I won't say his name. He'll definitely be listening. Suggest that we get a press pass. I volunteer to get a press pass.
There's no way they'd be like they're not letting these knobs come and ask Tiff Macklem a live
I would
question.
actually ask good questions, dude. The questions are brutal. Are you going to raise rates next month? And by how much, please? Anyways, we should try.
Well,
It's a
Loonie
fair
Hour
point. I
resolution.
think it's a fair point. Absolutely.
so this week is obviously, post New Year's. We're recording this on January 2nd, Thursday. Not a whole lot going on, in markets. Things are kind of quiet. People on vacation. So we figured we kind of like, we'll switch it up a little bit this week. Just Keith thought of the idea to, suggest some ideas that were maybe a little bit far-fetched, that were kind of like outside curveballs.
Maybe a little bit, even a little loony, maybe.
Yeah, maybe just like a wild prediction that maybe no one's expecting, and
We'll talk about it for 1 hour.
Yeah, no, we'll each kind of throw out our ideas that are a little bit off the cuff, that I don't think can be ruled out as a zero probability, but are maybe things people aren't considering. So that's what we were kind of thinking for this week.
Cool.
Okay, then.
I like it.
So yeah, we do it, and then we'll. So who's up first then? Let's have a Steve. You're normally first.
Well, yeah, I mean, I'll ref on housing here. I think that the consensus, at least on Twitter and YouTube in the comment section, is that housing is going to continue to sink lower. This is following the trend of the global financial crisis, that Canada is due for a housing reset. We're 2 years into a reset or a price decline across the nation. Surely this is going to continue because immigration is going to zero. We've got about 25% of mortgages renewing next year at higher rates. So the overall, we've got the issues that are happening in the new construction sector, developers going bust. This is just going to get worse and worse and worse. And that's the general consensus in, I think, the online space in general. So I guess my curveball is, again, this is not my base case. This is ideas that I think should be put out there as, okay, probably a low probability event, but something to consider. Is I think that could it be that bond yields fall lower than expected? So right now we've been more or less somewhat range bound. I think, the Bank of Canada cut rates 175 basis points in 2024. The Canada 5-year bond yield, which typically tracks your 5-year fixed rate mortgage, dropped by, I think, 25 basis points. So there's really hardly any movement for a multitude of reasons. And so, your fixed rate still came down because there was some, anyways, it's a little bit more complicated, which I'm not going to get into it. But we saw the fixed rate mortgages came down about 80 to 100 basis points in the calendar year. And so right now, most people, if you're going to go get a mortgage term today, yeah, it depends if you're going 2-year fixed, 3-year fixed, 5-year fixed. But I'm going to say on average, most people that are going out there getting a fixed rate mortgage today, you're going to be about 4.3 ish. Your variable rate today, depending on the lender, is going to be about, call it 4.5. So let's say the Bank of Canada cuts another 50 basis points, which is kind of expected. You'll see variable rate mortgages at about 4%, which is actually higher than where fixed rates are. So I think there's a case to be made that maybe the fixed rate market moves lower than expected. And I think one of the reasons to look at is really what's happening in China. China is the world's second largest economy. And we know that they're going through sort of a real estate crisis. We know that the bond market is telling us something very interesting, which is the China 30-year bond yield has now sunk below 2%. It's at 1.94% is now significantly lower than Japan's 30-year JGB. So what does that tell you? You look at the China 10-year bond, that's at 1.63, and it's just plunging. And this is, I think, the bond market saying there's a debt deflation that's happening over in China, and that's going to bring lower growth around the world and lower bond yields domestically here in Canada. And so, is there a possibility that some point next year, not in January, maybe not in February, but at some point you get your fixed rate mortgages down another, call it 75 basis points, and maybe you're around 3.5%. And so if you're renewing a mortgage, you're coming off of 2.5 and you're renewing at 3.5. You've had some wage increases over the years, your home prices have gone up. That's a pretty manageable jump for when you're renewing your mortgage to go from 2.5 to 3.5. I think that's very manageable for
And
most
Steve,
people.
just to jump in here, I think if somebody was at 2.5, I bet you a year ago or 2 years ago, they were probably expecting they would have to renew at 4.5, 5.5, or
It
6
got,
even.
yeah, I mean, we at one point for probably 2 or 3, 4 months there, we were in the sixes, right? So for someone that's like, hey, I took out a 2.2 and it's right now it's 6.2. I hope that doesn't hit me in 12 months. We're now down to, again, call it 4.2. Do you get some more movement in the fixed rates? You've had some wage growth. I think it could be very manageable.
So
And
I think here, Rich, Tiff was right after all then. Rates wouldn't go higher.
We're gonna stick the landing.
Okay. Okay.
so so long story short is I think that as rates come down, we know that Canadians are a funny bunch, which is they just buy payments. And so if they can buy a payment that is going to be quite a bit lower into a market where single family housing construction is running at 30-year lows in Toronto and Vancouver. We just don't build houses anymore, not single family houses. Do the resale prices jump? I think there's a possibility that they do, and I think they could jump by 5, 6, 7% next year for single family. So,
And the timing might be good for that as well, right? Because here we are in the winter, of course, and if this plays out, we're setting up for maybe the springtime, maybe something like that, where this could be in play.
yeah, possibly. Like I think, it's interesting, right? I mean, I think that the rhetoric right now, anyways, is that Trump is pro growth and it's bullish USD, and I think what we saw during his
At the same time, though, which politician or government is pro no growth? You have to be pro growth.
Excuse me. I know. The list
You know
is
someone.
very long. I know somebody. I know. Okay, I'll go.
They claim they're pro growth. They just don't know how to generate the growth. But
Okay. Yeah.
So Trump is pro growth. He's pro deregulation, but but if we actually look at his previous term, it was US dollar actually went down. He wanted to get the US, he wanted to weaken the US dollar, right? He called everybody else currency manipulators. He needed to get the US dollar down. And yeah, stocks went up, but actually for the first year and a bit, they didn't really go anywhere. And so, I same thing. Bond yields actually trended lower during his term. So I think right now everyone, like the bond market's getting ahead of itself. I think the markets have gotten ahead of themselves. They kind of priced in what is expected, and I think that the results of the Trump administration might take some time to play out. And so don't be surprised. Maybe you see that weaker dollar. Maybe you see bond yields fall lower. Maybe the stock market doesn't go anywhere. So long story short is I think that there's an outside case to be made that the housing market, at least on the resale side, particularly in the single family market where we haven't built any new supply, will track higher, and it'll track 5 to 7% higher, and mortgage rates will be under 4%.
So this episode is sponsored by the Canadian Realtors Association. They just paid Steve a lot of money to come up with this projection.
Well, we are sponsored by Neighborhood Holdings, which is a mortgage investment corporation that invests in mortgage. I'm just kidding, guys, but they are they're a great partner. They're a silent partner. They don't ask us to comment or say anything in any direction. But yeah, that's my outside case. That's not my base case.
But with that, if that happened, yeah, that would, because we talk quite a bit about, this trend, which way is Canada headed and everything. And as of right now, I mean, the trend will change, of course, at some point. And right now, I think a lot of people would agree the trend is not positive in a lot of parts for Canada. If this were to happen, it could actually help to, arrest, if you're in the climbing world, self-arrest the decline in Canada and help pull up everything at the same time. This would be an incredibly positive movement for the country.
Well, I mean, yeah, I'd like to add just to add to that. So, if I live in Vancouver, but if you go to other the major cities, whether it's Calgary or Toronto, every municipal government is looking and trying and making policy changes to upzone. So they're taking single family zoned housing and they're upzoning it, whether that be to townhouses, duplexes, condo towers. They're all upzoning because they're of the view that we have a supply crisis. We haven't been building enough housing for the people that have been coming into the country, and we need to change single family zoning, or at least take a chunk of it and convert it to higher density. And so when you look at the underlying land dynamics, again, in places like Vancouver, where you're land constrained, you don't build new single family houses because it's so expensive. And then you're saying we're going to upzone all the land via a mandate from the BC that is 3,000 square feet or larger, must allow duplex or triplex. So that's the case that I'm making here today. And again, I'm not saying it's the base case. I will want to add that I think when people hear about the issues that are potentially developing, or they are developing right now in the Canadian housing space, I think the big crisis that is unavoidable and everybody knows, and I will agree with, it's going to get worse, is the new construction market in the GTA. You can't sugarcoat it. It's a mess. It's a total unmitigated disaster. This year alone, 2024, I think there was 5,000 new condos, new homes that were pre-sold. I think the average is like 22,000 over the last 10 years. So it's completely fallen off a cliff. Valuations.
Just wait a second here. I want to make sure I heard that right. You said normally it's about 22,000.
Yeah.
Are pre-sold every year.
That's in the GTA?
GTA.
Yeah, in the GTA, yeah.
And last year in 2024, there was 5,000 pre-sold?
Oh, 5,000, yeah. Yeah.
Holy shit.
And what is it normally, like a 2-year cycle for it to come online? A pre-sold condos, 2 years to get built, a year?
Oh, no. These things take, call it at least 3 years to build, sometimes upwards of 5 or 6 years, depending on the height of the condo tower.
So I think
If you're building a low rise 5-story wood frame, it's much different than building a 40-story concrete tower, right? I mean, there's
Yeah.
So I think Bob Sacamano was talking about this a few weeks ago. What year is coming up where there will be not zero, but a very small number of new condos coming online?
think it was 2029 where you'll basically see, I think it was like next to zero condo completions, because like if you're not launching today, if you don't start construction on anything today, and then you got zero completions in a given year at some point. So yeah, I mean that space is a disaster. I mean, appraisal values are going to fall short, right? So like if you bought, this is what's happening, right? Is like, let's just say you bought a 1-bedroom condo near the top of the market in the last, between 2021 and the end of 2022. Like if you bought a condo in those sort of in that 24-month period, which is they keep in mind they pre-sold like a record number of new condos in that market, right? Ultimate speculation, market's going up, you just got to get in. So they pre-sold a huge chunk of condos. If you bought a condo in that 24-month period, let's just say you bought an $800,000 1-bedroom condo in downtown Toronto, but like the comps now are showing that it's only worth 700,000. The bank is going to lend you based on the appraised value, not on what you purchased. They're not going to say, well, you paid 800 at the presentation center 4.5 years ago, we'll give you the money. No, they're going to reappraise it.
This is sounding like Europe in some ways, with fantasy accounting and things.
Yeah. So now it's worth, let's just say it's worth 700. So the bank says, okay, we'll give you 80% loan to value of 700, not 80% of 800. We'll give you 80% of 700. So you got a shortfall now where you need to come up with excess cash, right, to increase your down payment to cover that short
for a thing that's for an asset that's falling in value.
Right. And so like the challenge is like, well, you're like, well, where do I find this money? Like it's like not that many people just have an extra, whatever it is, 60, 70, 80, $100,000 kicking around. And so they're going to have to find a way to come up with it.
But wait, sorry to jump in there, but couldn't developers sort of like do a little sweetheart deal where they, in order to complete the transaction, they kick you, they say you can pay it over 5 years, or you know what I mean? Like
no, but the developers don't have the cash either, right?
Okay.
I mean, they've got investors behind them too on all these projects that are expecting returns.
Okay.
And so people are saying, well, I'll just walk away. Well, if everybody just starts walking away, how does the condo corporation form? It's not possible. I mean, obviously the developer can then sue you for excess damages. So there's going to be these issues around closing, is kind of the gist of it. And so this is really an issue that's happened. Now, what we're seeing in a lot of cases, we've talked about this on one podcast, is these big banks. So let's just say, I'm not going to name any names, but let's say it's the guys in green. Okay. So they funded.
I know which one. I know which one you're talking about.
Yeah. So they funded
I think, or 3 anyway.
They funded the developer to construct at least part of it. So they said, hey, Mr. Developer, you pre-sold 70% of the building, you've got all these deposits, we want to help you build this project. So we'll take we'll provide a good chunk of the loan so you can build this 30-story tower. As it comes closer to completion, everyone, the guys in green are looking around saying, well, geez, none of these units are really worth what we sold them for. And if 20% of the building can't close, I mean, this is going to be a real problem. Like, how are they going to pay off the construction loan that they owe us? So we've seen what we call blanket appraisals, which is the guys in green will say, well, hey, Keith, if you want to close in your condo, why don't you just do a blanket appraisal? Like, we did this appraisal 18 months ago or 12 months ago and secured the value. So as long as you fund the mortgage to us, we'll still give you 80% of 800,000. So they're basically so essentially what they're doing is they're funding these loans at like whatever, 95 or 100% loan to value, because they have a blanket appraisal. Now, not every project has that. It's certain developers, it's certain projects. But I've seen and I've heard of quite a few examples where, again, the project should be worth 700K and they say, well, we've got a blanket appraisal at 780.
But just a question, because banks are not in the business of losing money, and they obviously aren't all dumb. There's a lot of smart people who work at banks, Keith. I know you might find that hard to believe, but it is true. And they also, won't they just renegotiate I mean, they do not want a loss on their balance sheet, and they certainly don't want to be owners of a condo. But also they have a built-in buffer. Surely, I mean, I've been at an investment committee meeting where you have a certain percentage or excess percentage on the loan that you have, given a certain amount of sort of eventualities that may or may not occur in order to protect yourself as investors. And also, don't the equity holders of that project have a say so? Right. So given your capital structure, you'll have your equity first and your first level of debt, and then your second level of debt and seniority, whatever. And so you might, if it's a 20% equity in that structure, you can wipe those guys out, but the banks won't feel it. The bondholders won't feel it. Do you know what I mean? So, I mean, it's not clear to me that you
somebody
go
else
directly
somebody
to
else
the banks.
essentially gets wiped out. Sure. Yeah. So I don't know. Like, I know that, so a lot of these big projects will have several banks, for example.
Right. That's right. The syndicated loan, is that what it's called?
Yeah, exactly. Yeah. So they're not going to take, one bank's not going to take all of the risk. They'll sort of spread it out against multiple lenders.
Or maybe they'll just securitize it and sell it to some like dog shit private credit fund.
Yeah, I don't know.
Or the Canadian government couldn't buy those MBS.
But I want to say that,
but let's go back to the first scenario that you were describing, Steve. That would help to soften a lot of this.
Yeah, it would.
And a lot of people across the country in the economy in that industry would be a lot better off if we get this scenario where they are assisted with lower rates.
Yes, for sure. But for sure, that would help. But
I'm being positive. I'm the positive guy in this scenario.
So the issue here is, like, let's just say, even if you come up with the excess cash, let's just say there's no blanket appraisal available. It's only worth 700,000 now. You come up with the excess cash, you find a way, maybe you borrow from friends or family, and you come up with the excess cash. Many of these units were like, people were just buying on speculation, which is like, I'm just going to buy it and flip it, or like maybe I was going to rent it out. But like, the problem is now the rates are so much higher. You've come up with the excess cash, but now you go and put a renter in there, and keep in mind the rents are actually declining right now. That, like, you're losing, $500, $600, $1,000 a month on this 1-bedroom unit, that, like, the rent is not covering all of your costs. And it's like, well, okay, so you manage to scrape and claw and close on the unit despite the value declining, but now you're sitting in almost a even shittier position, which is now you're carrying a negative cash flowing asset that, like, you're losing $800 a month. Well, like, how long do you want to do that for? Like, and then depends on what is your view of the market recovering. I think most Canadians think the market's going to recover in 12 months. I think the reality could be 10 years. And so at some point you're going to have to cut your ties, most likely. So that's another issue. And then, of course, what happens in a condo tower, when all the floor plans are pretty much the same, is you get one guy that says, screw this, I'm out. And he sets the price of the building. He sets the new comps. He says, shit, I paid $800,000 for this. It appraised at $700,000. I want my money. I'm out. I'll take $680,000. Get me out of here. And so he now sets the benchmark for the building at $680,000.
Yikes.
So, and then I want us just to clarify, to wrap my rant up, is I think this is a problem that is almost exclusively in the GTA. Yeah, Vancouver's got a few projects. There's a couple that are like absolutely nuts that sold predominantly offshore. Those guys are going to lose upwards of 7 figures in some of these units. But it's a relatively small portion of the market. The GTA is it's on a completely different level.
Ever been abroad and needed Wi-Fi? Download Saily. Tired of telecom oligopolies ripping you off? Download Saily. Want to avoid sketchy sim sellers at the airport? Download Saily. Saily might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saily is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saily offers flexible plans to fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saily's got you covered. No hidden fees, no contracts, just affordable, reliable data wherever you go. Visit Saily.com/Loonie Hour for 15% off.
All right, well, thanks for that. That was a good one.
That was a good one.
That was
I
a good
thought
one.
hopefully everyone, with some things.
I
to
feel
chew
like
on.
you're not. I hope you don't get aggregated and someone like clips you saying.
Oh, 100% I will. Some guy did that to me last week on my
I
YouTube.
know. I saw that last week too.
It was hilarious.
They just like told you to. I think the markets are going higher, and like they just like clip it. What are they? I'm sure there's a.
I don't know. I did like a 10-minute video on sort of real estate and that, it probably won't go up, but if it does go up, it's probably just a function of the currency being debased. And he took like a 10-second clip and was like, I think the market's going up. And he's like, look at this idiot like prediction. Like, anyways, I'm sure someone will clip that and try to pull an I gotcha. But
Yeah.
Who's got the second one?
So candidate number one from Steve is that a low probability event, which would have a major impact in Canada in this situation, is that housing gets supported by lower mortgage rates that will help to kickstart or ignite housing prices again, or at least to stop falling, and it gets a bit better for the industry. Is that a fair way to?
Yes, and
sum it up?
predominantly in the resale market, predominantly in the single family market,
and in Toronto specifically.
Okay, so that's like behind door number one in the Loonie Hour world. We have two more doors to look at, and then we'll square this
Circle back.
triangle thing back. We'll vote, and we'll see which one is.
Who's going second?
Okay, which I'm the most experienced, and we started playing a board game. What is it called? Ticket to Ride. People might play that one maybe.
Never
It's a
heard
fun
of it.
strategic game. But the person who goes first is the most experienced player, which is really the oldest. That's
I don't know
the-
why I went first.
So we'll do the opposite. Hey, so I'll go last, so then I can pick apart whatever Rich is coming
exactly.
up with. I have no idea what you're going to come up with.
All right.
So,
Well, are you ready?
Normally, I come up with
Closest
one
guy.
of your ideas, and you say, "Oh, I was going to talk about that." So I'll change on the fly if I need to. What do you got, Rich?
Okay, so mine's like U.S. equity and consumer related, but not necessarily maybe how you think. Which is, so the last couple of years we basically had an absolute surge in equity prices, and as a result of that, we've talked about the wealth effect, and a lot of people have both felt and very smug and very smart as they've seen their equity portfolios skyrocket, and as a function of that, we alluded to this last week, we have a sentiment with respect to equity markets is very, very high, and so is exposure. So if I'm not mistaken, I think that household assets, U.S. household asset exposure to equity markets is at an all-time high. If not an all-time high, it's the highest it's been in very, very, very many, many, many years. And the reason I bring that up is because one of the risks that I see is I think that equities aren't going to do as well as they've done the last 2 years. It's tough to have a third year of basically 25 plus year-on-year returns. But what I think the outside risk is, if there is, let's say, a wobble in these tech names, which is the Mag 7, which is Apple and Nvidia and whatever. Because the market is so highly concentrated in these few names, if you have let's say instead of just having a crappy year, let's say a 5% year or 10% year, or maybe -2, but if we have a full-on sort of shakeout due to, as like Steve said with the condos, which is everyone heading for the exits at the exact same time, and because the market is so concentrated, you basically have no bid, and you have a real sort of collapse in sentiment with respect to these few names. And the reason I bring that up, is sort of set up that way, is because that wealth effect is really, really important for the U.S. economy. And the reason I say that is because the U.S. total consumer spending by income is so concentrated to the highest income quartile. So the highest income quintile is 5, so quintile accounts for 38 or 40% of all U.S. consumer spending. And so, this is not my base case. I think that the U.S. will probably outperform. But if you do have a shakeout, whether it's because NVIDIA's earnings are fake or people sort of stopped overestimating AI or a number of different things that causes sort of a real collapse in sentiment and basically everyone pulling all their money out at the exact same time and that cascading and that specifically having a impact on the wealth effect of the most, let's say, the richest and the ones with the highest amount of assets, both at risk in the equity market and, in general, full stop. And the reason I set that up is because I think the reason why the U.S. economy has done so well, remember the U.S. economy is about 75% consumption, maybe a little less than that. Compare that with Canada at 65, and Europe is around a little bit less than that even. And so if you don't have this wealth effect, or worse, a negative wealth effect, which is like all these rich people who've seen their equity, their stocks rip, have, a down year of 25% or even more, 30%, I think sort of that will have a knock-on effect to consumer spending and then a knock-on effect on GDP growth. And so that's just something I think that people aren't thinking about. I think often people in my business, certainly on my side of the aisle, maybe Keith doesn't agree, but certainly strategists, economists always think that economic growth can propel earnings and those earnings will sort of lead to equity market doing well. Well, what happens if it's what if it's the other way around, where you have the equity market tank, and I mean really, really go in reverse for whatever reason? I don't know what the catalyst is, but let's just say in our scenario, it happens. And everyone who was really confident and allocated to the equity market at the highest it's been in a long time with maximum sentiment, all of a sudden has a huge, huge reversal. Well, maybe that will have sort of a knock-on effect to consumer spending and then GDP growth, et cetera. And so I think that that's just something I've really, really thought about and played with. Again, I don't think it's a high probability event, but it's our job to sort of.
So what is your low probability event, just to summarize it in less than 8,000 words? I got Steve's, right? Housing market does better than expected.
No way, he went on forever. Anyways.
No, but he concluded first. He did that. Yeah.
All right. Well,
get to the point. Let's go.
Remember, like you're in high school gym class now, so like,
my low probability event is you get a negative 30% equity market year. And that leads to a recession because of a collapse in consumer spending related to a massive negative wealth effect.
Reasonable.
I could have said that. You're right, Keith. I could have shortened my low probability event. And again, the reason I bring that up is because so much of U.S. consumer spending is tied at the top income quintile, and that top income quintile is highly correlated with exposure to equities and the equity market.
Okay. And
what's that old analogy? Dog's tail wags or whatever.
The tail wags the dog, I guess.
Tail wags the dog.
Yeah.
Like AKA does the stock market drive, spending and economic growth.
Right.
I think it absolutely, yeah. This wealth effect, that you read about in your textbooks and stuff, it's real. It absolutely is. If your portfolio goes up and on paper it's a lot more, you feel better. Maybe you sell a little bit and do something with it.
Like all those crypto bros buying Lambos at the top of the market.
But it might be a good trade in some ways, right?
Yeah. Well, there's another piece to this too as well, because there's been this talk of like a K-shaped recession or a K-shaped recovery, which is to say that different parts of your economy, different households, sort of wealth and income. Basically, the recovery is directly related to the distribution. If you're rich, you've had a really great time. As I said before, your assets have gone up. Your
I was
assets have
waiting
gone
for
up.
that. I was waiting for that. I knew that was coming.
It's funny.
Your assets.
I had a meeting with this gentleman a few years ago, and we're chatting, and his name is Frank, and he's describing this thing to me and going back and forth. He said, "Well," he said, if I can be frank," and I said, "But you are Frank." And he looked at me. He had no idea what I was talking about. So
That's hilarious.
go ahead, Rich. You
He
are
pulled his
Rich.
money immediately. Eh?
That's right.
Like, but you are
Anyways, where
Frank.
was I? So there's been the people have talked about a K-shaped recovery, and meaning your recovery or how you feel the economy has been doing has been related to how wealthy you are, how much income you have. So the higher income you are, you've seen your wealth increase, you've seen your income, your job prospects increase, you've seen your stock market portfolio rise, and then on the poor end of that scale, it's been sort of the opposite. And one way that you can really see this, like in a really clear way, and we'll definitely show this chart in hopefully if Jeff can plug it in, which is delinquency rates for credit cards between and the split between large banks and small banks. So in the U.S., there's 4,000 banks or many banks, whatever. And although obviously, like in Canada, just a couple of banks have a lot of the market share. But the key piece here is large banks basically cater to richer, wealthier people with more assets, et cetera, and in generally in cities. And small banks cater to lower income people with generally fewer assets. And you can see that the delinquency rates for small bank credit cards is up around 8 or 7.5 or what have you. So it's skyrocketed. It was increasing before COVID and then shot up even more after COVID. And for large banks, which is again those wealthier, higher income people, those delinquency rates are actually very low. It's around 3% or so. And so not only does that literally look like a K, but it really sort of exemplifies what I mean by this K-shaped recovery. And it would be interesting, following on my low probability event, if you do have a real intense market correction of -30 or whatever, that you sort of have a reversal of that. Or that is to say that the delinquency rate and sort of the prospects and consumer spending and the attitudes and the sentiment and the consumer confidence of richer people starts to catch up to what we've seen, which is high delinquency rates, low consumer confidence of much poorer people. And that will have an effect on GDP growth, monetary policy knock-on effect.
What do you think, Steve? Are you buying this story, or are you selling this
I think
story?
it's pretty reasonable. What's funny is I've been reading all these like articles that like come up and people share them and everything. There's been all these like headline articles that have been coming out and saying making the case for 100% equity allocation. The 60-40 is dead and it should be 100% all equities. And it's like you don't read articles suggesting 100% all equities at the bottom. Right. These are the articles and the headlines that come out near sentiment.
Because most people, I think people know you should buy low, sell high.
Wait, let me write that down, Keith.
Yeah, you write it down. Okay. What crayon are you using, Rich? Which one do you have?
Red.
By the way, is that a new jacket? I like your jacket. Is that new?
I'm freezing.
Yes.
I noticed it's not a Patagonia.
No, it's the North Face.
Yeah, I like it. I like those with it's a hood on as well, right? It's a hood.
Oh yeah, it's got the hood.
Yeah,
It's great.
Pull it
It's a
up.
great jacket.
Pull it up.
There you go. I'm
Zip
ready.
it up,
I'm
too.
ready to face the bear market.
And do you have a string? Can you draw it tight around
No
your
string. No string.
No string. Okay.
Okay.
Afford it.
Okay. So
Summarize.
most people buy high, sell low. I think that's what you're saying, Steve.
Yes.
No,
Just like your
wanna
pre-sale
buy
condo.
low and-
Everybody wanted one when the price was going to the moon, and there was lineups around the corner, and nobody wants them now that they're giving them away. Right. So I don't know. I just think that sentiment top for stocks, it seems excessive today, but does not say
with
that.
the 100%, in theory, that's instead of 60-40, you go 100-0. Going from 40 to 0 to be dramatic, I think that's clearly going in the right direction. But I think though where people are making the mistake or the error, it's assuming that it's always just stocks and bonds,
Right.
and that's it. Like we've reimagined the 60-40 allocation. We changed this a few years back. A lot of success with it. So I think they are right, but sometimes you can, by backing away from one market or one anything, you can back yourself into something else. So maybe that's what's happening now, Steve. People are going all in on equities because they've done well, and they are afraid of the bond market. So,
well, Keith, we've had him on, we had Mike Green on the show, and he talks a lot about just what's happening with these passive flows, right? Which is everybody's been trained now to buy the S&P 500 index. You just dollar cost average, you take a part of your paycheck or your pension or whatever, and you just buy the S&P. And the problem is it's now allocating. It's this non-emotional purchase that just keeps allocating more and more to the big names. And so the big names are becoming such a larger and larger share of, like, Rich, what is the top 7? What is it like what is that round now? 50?
What percentage?
Yeah, what percentage of the S&P is just like,
It's like 34, 35%, depending on the day, even higher.
yeah. So it's like, well, it's like, so people are now making the argument, of course, that like, well, are you really getting the diversification that you think you are?
No, you're not at all.
Right. So it's almost like, too much of a good thing becomes like a bad thing, which is like everybody,
and that's where you get a lot of this sort of like self-correct, a course correction, taking place. So like at the professional money manager level, like they would have risk parameters in place where, you get these capped weighted
ETF.
benchmarks or funds and things like that. And, because, in the Canadian markets, I don't know what was the financial sector equal now?
38%.
38. I mean, Canada is a real tough market really to diversify properly, because you either
You can't.
you go all there or all there, or there's nothing in between. Like try investing in the Canadian healthcare market, right? What do you do?
No, it's like 1% or 2% of the equity market.
Yeah, you are right, Steve. And you get the passive flows that Mike talks about quite a bit, but it can also though change rather quickly when you get one of these disruptive events. So now then, okay, so we have the housing market does better.
There's one more thing.
Rich just crashed the market and dashed dreams of everyone.
He
has his foot up.
Well, no, because I think the reason I bring this up, one last thing, Keith, and then is that during the dot-com bubble, the equity market fell 50%, and it was obviously it was a bloodbath. But what's really, really interesting about that is like basically there was no recession. You say, what do you mean? Of course there was. It was actually revised away. There was actually only 1 quarter of negative GDP growth, which is for the U.S. Excuse me, sorry to be very specific, which is really interesting. And the other thing that's also really interesting is the S&P Case-Shiller Housing Price Index had 1 month of negative decline, of month-on-month decline. I don't know. I can't speak. It only declined 1 month in that period. So you had the equity market tank. You had GDP. You had actually GDP do relatively okay considering a collapse, really, in equity prices. The concentration obviously sort of dissipated. The sentiment naturally dissipated. And so you can have these, and we're seeing a lot of the similar things. Instead of tech, being like people were talking about technology in 1999, now it's AI can like make me a cup of coffee and drive me to Saint-Tropez or whatever. We're having sort of a similar. There's some
Saint-Tropez.
Isn't that rather ironic?
That's not something you hear very often in the Canadian market.
Well, I don't know. People. I just think that the parallels are there. Now, obviously, people will say, Richard, the companies are different. Back then, there was no earnings. Now there are earnings. Back then, there was no margins. Now there are huge margins that are fat and protected with large, deep moats around these businesses and operations, etc. Fine, I get it. But there are parallels, and I think it was worth noting. Okay, now it's your turn.
Okay, Keith, fire away. You got 5 minutes.
Yeah, okay. So one thing to add that's fine. I can do mine in 2 minutes. But so Rich, what you just described really is that, with the 2000 tech bubble when it broke, again, it's just all capital flows, because eventually they figured out, hey, there wasn't really a recession, and this was okay. And that's my point I make. Like capital flows are going to drive a market higher or lower, right? It'll go both ways. And even though today, you just said, hey, the fundamentals look great for this part of the market and things like that. But you can have any moment a trigger event, and that can have money just flooding, for the door. So one positive thing about that period, people who were invested in funds, like a mutual fund structure or something else, they lost a lot of money, but, there was always some residual there. Um, Canadians will recognize this at the time. A lot of Canadians had a lot of money in Nortel stock, as an example. And what price did that go to?
Zero.
Yeah, it went to zero, right? But I think that could be, I think the problem or the challenge today is where like these Magnificent Seven stocks done so well, and then people start moving then to the next, the next derivative with a knock-on effect. Well, if they do well, who's going to do well with them? And you go on. And once you go down that path, I think that's where you could find, some parts of the market that may not do well. Okay, so Rich is saying, hey, we could have a sharp correction in the equity market, which could spill over them because of the wealth effect. It will have a slower economy and so forth. Steve got the better economy. What I'm going to come up with is I think the euro is going into the 80-cent range, the low 80s.
So past
Just for
parity.
context, what's it at right now?
We're at
It's
103.
104. Sorry.
103 and 103, 104. To give you an idea, at one point, I think it was an 01 or 02, euro did hit about 84 cents, I think, Rich, or 82, somewhere in
Sorry, what
that
year?
range. 01, 02.
Oh yeah, but that
03.
doesn't count.
Okay.
It was like a year old. That doesn't.
Okay. But my
Keith
point
doesn't
is
like
that
that answer.
I was laughing. Oh, that didn't count. That's
It
Europe,
didn't.
right?
The euro was a year old. It's not the same as 25 years in. Anyways, keep going.
Okay. Euro is going to the low 80s. This is going to be triggered by a major crisis in Germany. Germany has the election coming up, and I think it's going to be a complete shit show. I don't know if the AfD will get a majority or not. If they don't, it's going to create even more of a real crisis over there, political, and I don't know how else they'll figure it out. It's even to the point now where Elon Musk is involved, on X, talking about the German election that's come up. So this is a huge moment not only for Germany but for Europe, and at the same time, we know, as Rich has shared with us, Germany is struggling because of what one word, Rich?
Stupidity.
Energy,
Sorry.
and that's not going to get fixed anytime soon either. The German export machine has been hollowed out because of the energy sector. They've lost a lot of market share to China, or they're not selling as much. At the same time, the French are undergoing a budget crisis right now as well. And because the economic outlook in Europe is not that strong compared to, say, what the Americans are looking at, the Germans are going to be encouraged to start doing deficit spending. And Steve, do the Germans like to do a deficit spending budget strategy?
No, I think they learned. A couple tough lessons back in the early
Yeah, it's not something
1900s.
they want to do. And, we talked about, China's 30-year, yield is down to its lowest level ever. If you look at the German 10-year government bond yield, that was negative briefly in 15 or 16, I think. And then it went negative from 20 to 21 into 22, I think. I think the 10-year can actually go negative again through all this. So all this packaged together, you're going to see euro currency get absolutely smoked. The European financial sector will get hit pretty hard as well, which happened back in 13 or 14, I believe it was
13,
as
14,
well.
15.
Yeah, something like that. And I think this, like, I don't see the Canadian marketplace facing the same potential risk what Germany is right now or Europe is right now, in part because we do have the resource sector here, and whether it's being efficiently managed or not, I think not, but the opportunities there is for that. Europe doesn't have that opportunity. I don't know what they're going to do. So the event I'm talking about, for euro going to 80 cent range, it means that, hey, something big has really happened, which is really going to trigger capital flows all over the world flying around. But this is the one I see as the most, as a low probability event, but you can easily line these guys up and say, yeah, I can see that happening. So that's my real quick version
That's
of
your,
them.
again, just to clarify, this is, in your view, a low probability event.
Yeah, he did not get the assignment. You're
I
like
didn't?
convinced it's gonna happen.
I know. I just convinced myself. Yeah, I'm now all in on it.
You're
But
like,
this
it's a
is
low
supposed to
probability
be
event
this.
that I
No, but remember, that's a 20% decline, and that's
Right. Okay.
calling
Fair,
for
fair,
the
fair.
financial sector to implode, for the German government. And again, like, within 2 months, we'll find out what's happening in Germany. And if you remember back when the Catalonia region in Spain had their referendum? I don't know what year it was, 11, 12, 13,
No, it was later than that. Well,
15,
they've had a couple of
16,
referendums, to be fair.
17, 18, 19.
Anyway, so this is a
I'm going to hit it.
low probability event.
Yeah, but
Well,
my point though with
80,
the
80.
Catalonia event was that when it happened, the EU sent in troops. They would not allow that vote to happen. Like they crushed little old ladies' skulls and everything, right? It was not a pleasant day. I think
2017.
Germany could go in that direction here very, very quickly. We hope it doesn't, decline to that point. But this is the low probability, very high risk event, that we would look at. So we're going to do a vote here. We have housing does better, rich market going down, the U.S. economy goes down, and then I say euro doesn't do well. We're going to do I
So
think
what's
we
the
just
vote
did.
on though?
Yeah, which one?
Which
Which
low
happens?
probability event has the highest probability?
Yeah, I think that's what it is. And we just did a little vote in the chat room, and it's a three-way tie. I think we all voted for each other, for ourselves, I think. No, we
Rich,
didn't
go
do that.
ahead.
I think the low probability event that has the highest probability, I actually think is yours, Steve. I think it's yours.
Okay.
I say with chagrin. What about you, Steve?
I'll take Rich's. Well, right back at you, buddy. Rich's U.S. stocks declining, exogenous event, 30% drawdown. Call it. I'll go with that one.
Keith.
Oh dear. What would my vote be called?
I think you should just pick yourself, and then we can call it a draw.
No, my selection is Rich's event as well. I think that's the higher probability event of the three.
Low probability events.
Of the low probability
I like this.
event.
It's a good
I
game.
agree with your Eurozone thesis. I just think that the drawdown in the currency was a little excessive for my taste. But
Well, I couldn't say it was going to go to 98 or 99.
Yeah,
but then it's not, like
the direction is fundamentally there.
Yeah, so I agree with that, Steve. I think that's a really, really important thing, and it's such a big risk that it just seems like nobody's talking about it on not to belabor this point, but mainstream media and CTV and CBC. It's like Germany.
But hey, guess who's talking about it first?
Yes, we are. That's right.
Looney Hour, man.
And speaking of which, today there's not much news data. There's not much data out this week, obviously. But what did come out, speaking of Keith's point, which is the S&P Global's PMIs for a bunch of European, and they were not good. This includes the UK, by the way, and you could see there just the manufacturing sector, which is the bulwark of Germany, just came out.
My God, Steve, the first Loonie Hour episode of 2025, and Rich manages to get the diffusion index pushed in there quietly.
Yes,
well done, man. Well done.
Thank you. Diffusion index is very important.
Yeah, it's a good spot to wrap it up. We'll kind of get back to more regular programming here as financial markets start to kick into high gear, sort of in the January period here, and working on a few guests. If you guys ever have any good recommendations, we get a lot of very bad recommendations, but if you have good recommendations, please don't hesitate to email us. Yeah. Friendly suggestion is not to nominate yourself, but that's all I got to say.
Happy New Year, everybody.
Yeah. Happy New Year, and we'll see you next week.